Welcome to Breaking News to Trading Moves, where we look at financial reports and research to pull out some market intelligence for you. Today, we're digging into the Q3 2025 results from Bank of America. That's ticker BAC. And this isn't just about BAC's own numbers. It can give us clues, maybe, about which financial sectors might be doing well and which ones could be facing some challenges.
Yeah, that's right.
So our goal here is to look past just the headline earnings and try to map out, who potentially benefits and who might feel some pressure based on this report.
It's a good way to look at it. And with BAC, the overall performance was pretty strong. Their profit for the quarter climbed to $8.5 billion.
$8.5 billion.
Yeah, and that translates to earnings per share of $1.06. This was mainly driven by a couple of key areas performing well.
Okay, so let's break that down. Bank of America, huge consumer bank, obviously, but you're saying the growth this quarter was maybe more focused elsewhere.
Yeah.
What specifically pushed that profit up?
Well, the big story was definitely capital markets activity. We saw investment banking fees jump up by 43% compared to last year.
43%.
Yeah, quite a jump. It suggests, that deal flow is really picking up again. The other piece was net interest income, or NII. That rose by 9%.
Okay, 9% on NII.
And management also gave some Q4 guidance for NII. They're projecting something like $15.6 billion to $15.7 billion. So you had this combination of strong fees and pretty solid interest income driving things.
That 43% growth in investment banking fees, that really does seem like a powerful indicator. It sort of backs up what people have been hoping for, right? A return in deal making.
Absolutely. What the Bank of America result does is it kind of confirms this broader industry trend. It suggests the capital markets activity is really improving across the sector, not just, at one bank.
And we've seen hints of this before, haven't we? This BAC report isn't happening in a vacuum.
Exactly. You can look at their peers. The comparisons confirm strength in trading and investment banking, pretty much industry-wide. Take JP Morgan, ticker JPM.
Right.
They previously raised their own 2025 NII outlook and reported record markets revenue. So when you see the two biggest players both showing this kind of strength, well, it suggests the recovery is pretty broad.
Okay, that makes sense.
And this brings us to the whole interest rate picture, the Federal Reserve.
Because the success of BAC and JPM, it's happened in a particular rate environment, right? And now there's talk about potential rate cuts. That hangs over everything.
That really is the key dynamic, isn't it? If the Fed does start easing, how does this environment, which seems to be helping banks now, how does it change? Well, it creates that classic trade-off you see in finance. If the Fed eases, it immediately impacts net interest income. Rate cuts could slow down that NII growth, taking away some of the tailwind banks have enjoyed.
Okay, so pressure on NII.
But it's not all negative for the financial sector. Lower rates could actually stimulate loan demand. And maybe more importantly for the investment banks, it could spur, a new wave of IPOs and other issuance activity.
So the activity just moves from the interest income side to the fee side.
Kind of, yeah. The revenue mix could change. It shifts from the rate-sensitive part of the balance sheet potentially over to the fee-generating businesses.
Okay, so that sets up some clear distinctions. If BAC's results are a signpost, where do we start looking for the direct beneficiaries? Which parts of the financial world are best set up to capitalize on this renewed capital markets activity?
Well, the first group, and maybe the most obvious, are the big bulge-bracket investment banking and trading firms. The rationale here is really about scale.
Scale and leverage. Why do firms like that benefit more, perhaps?
Well, the BAC results confirm this broad pickup in deals, M&A, underwriting. These huge institutions, think Goldman Sachs, ticker GS, and Morgan Stanley, ticker MS, they have large fixed costs tied to their global operations. So when that deal pipeline fills up, each additional deal generates high-margin fees without needing a huge increase in their own spending. They're sort of built to capture a lot of the upside from a busy M&A market.
Got it. So more deals mean very efficient profits for those global giants. Now, the research also highlights a second group, the advisory-focused M&A boutiques.
Right. This group benefits from being specialized. We know deal-making and advisory fees are picking up, global M&A volumes are up. For these pure-play advisors, the ones focusing almost entirely on strategic advice rather than, say, underwriting the financing.
Like Evercore or Lazard.
Exactly. Firms like Evercore, ticker EVR, and Lazard, ticker LAZ, they gain a lot of operating leverage too. Their model is different from the bulge brackets, which do everything.
Also,
boutiques are really about that advisory fee. As M&A deals move from just talk to actually getting signed and closed, These firms collect their advisory fees, which can be substantial. They're kind of lean operations waiting for these high-value deals to close, and BAC's results suggest those deals are closing now.
Okay, so if the banks and the advisors are getting busier, that leads us, I guess, to the third potential winner category,
Huh.
the stock exchanges and market infrastructure companies.
It's the natural next step, really. Activity at the banks eventually flows through to the exchanges, a
Mm.
busier IPO calendar, more secondary offerings, just more trading in general.
Mm.
All that supports revenue for listing services, data sales, transaction fees at the exchanges.
They're kind of like the toll roads for the financial system, right?
Yep.
More traffic, more tolls.
That's a good analogy, yeah.
Yeah.
Both the NYSE, which is owned by Intercontinental Exchange, ticker ICE,
Mm-hmm.
and NASDAQ, ticker NDAQ.
Mm-hmm.
They've already been talking about increases in capital raised and listings through the first 3 quarters of 2025. They benefit from volume, and volume tends to rise when capital markets are active like this.
All right, so that covers the potential beneficiaries. Now, let's flip the coin. Every trend that helps one group can create pressures elsewhere. Given this same environment, especially the talk about potential rate cuts, which segments might face some headwinds?
Okay, the first area to look at, and it's very directly tied to rates, is the online brokers. Specifically, the ones that rely heavily on the yield they earn from client cash. Balances the sweep accounts.
Ah, okay. So we're talking about companies like Charles Schwab, ticker SCHW, and maybe Robinhood Markets, ticker HHOOD. Why are they vulnerable if the Fed cuts rates?
It's core to their business model, or at least a big part of it. These platforms hold client cash that isn't invested, right? They often sweep it into very low-risk accounts overnight. They pay the client a small interest rate, maybe, and pocket the difference between what they earn on that cash and what they pay out. That difference is the cash sweep revenue.
And that's been very profitable with rates high.
Extremely profitable. It's been a huge earnings driver while rates were up. But if the Fed cuts rates, the amount they earn on that client cash drops almost immediately. Their profit margin on that cash shrinks, even if clients don't do anything different.
So it directly hits their revenue.
Yeah. Some estimates suggest that for every quarter point, 25 basis point rate cut, it could trim a noticeable amount off their quarterly revenue if they're heavily reliant on that sweep income. It's almost the opposite of the investment banks. They tend to do better when rates fall. These guys often do better when rates are high.
That's a very clear potential pressure point. Okay, the second area of concern you flag is within banking itself specifically, regional banks that depend heavily on net interest margin, NI, and have smaller fee-generating businesses.
Right. This goes back to that rate dynamic we talked about. Rate cuts can squeeze the net interest margin for these banks,
Yeah.
especially if their deposit costs stay high while the yields they earn on loans start falling.
What do you mean by sticky deposits there?
Well, think about it. When rates were rising, banks had to offer higher rates on savings accounts, CDs, things like that to keep customers from moving their money. That's their cost of deposits.
Right.
Now, if the Fed cuts rates, the interest banks earn on new loans might fall quickly. But they might still be stuck paying those higher rates on existing CDs or savings accounts for a while. So their income falls, but their costs stay high, at least temporarily. That squeezes the margin.
And banks without big fee businesses feel this more.
Exactly. If a bank doesn't have large investment banking revenues or big trading desks or substantial wealth management fees to act as a buffer, they're much more exposed to that net pressure.
It really highlights the difference between a giant universal bank like BAC and maybe a more traditional lending-focused regional bank. The research mentioned PNC Financial Services, ticker PNC, and U.S. Bancorp, ticker USB, as examples here.
Typical examples, yes.
Okay. And finally, the third area facing potential headwinds relates to the consumer, specifically credit card lenders if delinquencies start climbing again.
Yeah, consumer credit health is always something to watch closely. Even though some recent data points might show things stabilizing a bit, overall delinquency rates and charge-offs are still higher than they were before the pandemic.
So the risk hasn't gone away entirely.
Not entirely. It means provisioning risk is still relevant. Provisioning is when banks set aside money to cover expected losses on loans that might go bad. If charge-offs stay elevated, banks have to keep putting capital aside.
And that directly impacts their earnings, right?
It does. It acts as a drag on their reported profits, regardless of what else is happening. So even if other parts of the economy look okay, if consumer credit doesn't fully recover, that need for provisions could weigh on lenders like Capital One Financial, ticker COF, and Discover Financial Services, ticker DFS.
Okay. So bringing this all back to the Bank of America Q3 report, It seems to highlight this tension in the market, doesn't it? You've got these tailwinds for capital markets and advisory, backed up by BAC's results, but then you have potential pressure on rate-sensitive firms and this ongoing caution about consumer credit. It's quite a mixed picture.
It really is. And maybe, as you look ahead, the thing to keep a close eye on is the consumer credit piece. We mentioned the recent stabilization in delinquencies. But the key question is that just a temporary pause? Maybe due to seasonal factors or something short term. Or is it the start of a real sustained improvement in credit health?
That makes a big difference.
It makes a huge difference for the whole financial sector heading into next year. That's a major variable.
Definitely something to watch.
And of course, we need to state clearly, everything we've discussed today is based purely on the analysis and opinions and the research and notes we reviewed. This isn't financial advice. It's not a recommendation to buy or sell any specific security, including Bank of America, GS, MS, EVR, LAAA, ICHW, HODE, PNC, USB, COF, or DFS.
Absolutely. Just analyzing the information presented. Well, thank you for walking us through that. It definitely gives us a clear picture of the potential winners and losers coming out of this Bank of America report. And thank you for joining us on Breaking News and Trading Moves. We look forward to analyzing the next set of reports with you soon.